Okay, you guys. We'll start here with the ACC 120 or Financial Accounting Chapter 1 lecture. Um, your text starts out by giving you a definition of a business. Now, I feel like you all have a pretty good idea what that is going in. They just say in general terms, and I'm going to paraphrase here, but a business provides goods or services to customers by taking basic inputs such as materials and labor and using those to provide outputs to the customers. Now, and again, I feel like you probably knew that going in. Now, let's think about it for a second. Why do people go into business? And I hope you said, I'm going to guess you probably said to make money, or we're going to call that to make a profit. And how much profit do people want to make? I hope you said maybe as much as possible. Your text says the objective of most businesses is to maximize profits. Not always add within the law. You can make as much money as you need or want in the United States legally, of course. Now, your text also gives you a definition of profit, and here in Chapter 1, I don't feel like that's the best accounting definition of profit. So let's look at one of those. Our accounting definition of profit is the difference between amounts earned from customers for goods or services provided and the amounts incurred for the inputs used to provide those goods or services. So in accounting, we're not necessarily concerned with when did the customer pay us or when did we pay for the inputs used to provide the goods or services. What we're going to look at for a given period of time is what did we earn from our customers for that period of time minus what costs were incurred to provide the customer with those goods or services. And again, the objective of most businesses is to earn a profit. Now, your text mentions three types of businesses. We have service businesses. Now, a service business, of course, is going to provide a service for a fee. Some examples would include maybe a doctor's office. You go see the doctor, they provide that service to you for a fee. Another good example to me is a taxi service, or one of my new favorite businesses, Uber, which is a kind of a modern ride-sharing type of taxi. Anyone who provides you with a service for a fee. And here in financial accounting, in the first 4 chapters, we're going to deal strictly with a service business. Now, merchandising business, they instead of providing service, they sell goods to customers. Now, they don't make a product. They generally buy a product from a manufacturer or wholesaler and then sell that product to either a wholesale or retail customer. Wholesale being a business-to-business sale, retail being business to the final customer sale. We'll deal with merchandising businesses in Chapter 5. Now, manufacturing business, they actually produce a product for sale to typically other businesses or wholesale customers. And we'll talk more about them in ACC 121, our managerial accounting course. The role of financial accounting in business is to provide stakeholders with information in the form of financial statements to use in assessing the economic performance and condition of a business. All right, stakeholders would include, but are not limited to, the owners of the business, managers and employees, investors or potential investors, creditors, or you could also say potential creditors, and then the government would get a copy of those financial statements in the form of a tax return. Financial statements are just reports produced by the business to provide information to these stakeholders. Again, about the economic performance and condition of the business. Let's break those down a little further. The economic performance of the business, how did the business perform in, let's say we could say the last year or any given period of time? We would judge that typically by, did the business earn a profit or incur a loss during that given period of time? We'll usually look at it as a year. Okay, so for the year ended December 31st, 2014, did the business earn a profit, which we'd call net income? Or did the business have a loss, which we'd call net loss for the year? Our financial statement, we're going to get to these shortly, but our financial statement that speaks to the economic performance of a business would be the income statement. All right, now the financial statements will also allow us to assess the economic condition of a business. Now there we're just looking at what does the business own, which we'll call their assets, less what does the business owe, which we'll call their liabilities, and that gives us an idea of the economic condition of the business, or what position is the business in on that last day of the year. The financial statements must be prepared in accordance with generally accepted accounting principles. Our acronym there, we call that GAAP. And these are our uniform set of rules for financial accounting in the United States. Or we'd say U.S. GAAP, or generally accepted accounting principles. You guys, by requiring all companies in the United States to use U.S. generally accepted accounting principles, that facilitates consistency and comparability among companies. What we're talking about there, if you're a potential investor, you could take a set of financial statements for Coca-Cola, take a set of financial statements for Delta Airlines, and you could compare those two, decide maybe using those financial statements, which of the two companies you'd like to invest in. And you'd know that both sets of financial statements, even though they're in different industries, both Coca-Cola's financial statements and Delta Airlines financial statements were both prepared using this same set of rules. That makes them comparable. Now, the governing body with authority over United States generally accepted accounting principles is the Financial Accounting Standards Board, and we abbreviate that as FASB. On our financial statements, there are a couple of concepts I'd like to mention and briefly speak about here in the lecture. The business entity concept just states that assets and liabilities, which are property and debts of the owner personally or the shareholders, should not show up on the books of the business. So the owner's house and mortgage should not show up as an asset or liability on the financial statements of the business. A truck and loan associated with a truck that's used solely in the business should show up as an asset of the business, and then any debt associated with that truck, the loan that we took out to buy it, should show up as a liability of the business. I think that should make sense. Personal assets, personal liabilities should not show up on the books of the business. Cost concept just states that we will record assets of the business at their cost. So if we buy land that costs $50,000, we want to put it on the books at $50,000, even though it may have appraised for $80,000, and shortly after we buy it, we might receive an offer of $60,000 for it. We'll put it on the books at its cost of $50,000, and we'll leave it on the books at its cost of $50,000 until the land were maybe sold in the future. Then we'd make some changes. Our accounting equation just states that assets are equal to liabilities plus stockholders' equity. Can also be written assets minus liabilities equals stockholders' equity. Let's talk about that a little bit. We said assets are property of the business, or really anything of future benefit to the business. We'd consider an asset. Liabilities would be debts or future obligations of the business. The difference in those two would be the stockholders' equity in the business, or the part of the business that the stockholders or owners actually have claim to. So I think an easy way to look at this, you guys, on a personal level, an asset for you would be your house. Okay, a liability associated with that house, we call that your mortgage. And the difference in those two would be your equity in the house, or the part of the house that you actually own. Okay, so if we bought a house for $200,000, let's shoot big, minus, let's say 10 years into it, the balance on our mortgage is $150,000. Then our equity in the house would be $50,000. This is the part of the house that we actually own, or that you would actually own. $150,000 is the part of the house that the mortgage holder or bank actually has claim to. And then the value of the house, assuming it hasn't gone up any in 10 years, which it probably would, but we'll say the value of the house is still $200,000. Okay, now we do the same thing for a business, you guys, except a business would have several assets: cash, accounts receivable, where we've provided customers with goods or services today, and they promise to pay in the near future. Buildings, land, equipment, all those would be assets of the business. Their liabilities would be maybe accounts payable, where they have made purchases of goods or services today and promise to pay in the near future. Any loans would also be liabilities. We'd add up all the assets of the business and add up all their liabilities. The difference in those two would be the stockholders' equity in the business, or the part of the business that the owners actually have claim to. The creditors would have claim to the other portion of the assets, and those creditors' claims are represented as liabilities. You guys, we've already mentioned financial statements several times. We have four basic types. First one is an income statement. There we'll calculate the profit or loss of the business for the year. We call that net income or net loss. We'll take what the business has earned from their customers for the year, which we call revenues. So revenues minus expenses, or cost incurred to earn revenues. And then we get a net income or a net loss. If it's a positive number, we call it net income. A negative number, we'd call that a net loss. And again, revenues are what we've earned from customers for providing them with goods or services. Expenses are costs incurred by the business to provide those goods or services. Okay, on the statement of stockholders' equity, we're going to call that one the retained earnings statement. And retained earnings is going to be equal to net income since the business began, or profit since the business began, minus any net loss since the business began, minus any dividends paid out to the owners since the business began. Dividends would just be a return of profits to the owners of the business, and the owners of a corporation we call stockholders. I got one too many S's on loss there, sorry. Okay, now a balance sheet is just a summary of what we went over on the accounting equation. It's assets minus liabilities, and that's going to equal our stockholders' equity. Now, these first two, your income statement and retained earnings statement, would be prepared as of a specific, your income statement and retained earnings statement would be prepared for a period of time. Your balance sheet would be prepared as of a specific date. Now, our statement of cash flows just looks at cash coming in from operating the business, so cash received during a period of time, less cash paid during that same time period. Okay, here in financial accounting in the ACC 120, we're going to work with the income statement, the retained earnings statement, and the balance sheet. We'll get into the statement of cash flows in the first part of ACC 121, managerial accounting, and I hope you all come back for it next semester so you can see how the book ends. All right, thanks you guys, and if you have any questions, please be in touch with me.